and welcome to another segment of Accounting 101. My name is Dr. Annette Moultrie, and let's see what we have in store for you in this video. But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Also, click on the notification bell so you'll be notified of upcoming videos. Chapter 5, Accounting for Merchandising Operations. Merchandising Operations. The learning objectives for Chapter 5 are 1. Describe merchandising operations and the two types of merchandise inventory systems. 2. Account for the purchase of merchandise inventory using a perpetual inventory system. 3. Account for the sale of merchandise inventory using a perpetual inventory system. 4. Adjust and close the accounts of a merchandising business. 5. Prepare a merchandiser's financial statements. 6. Use the gross profit percentage to evaluate business performance. 7. Account for multiple performance obligations using a perpetual inventory system. And 8. Account for the purchase and sale of merchandise inventory using a periodic inventory system. So the first objective, describe merchandising operations and the two types of merchandise inventory systems. So what are merchandising operations? A merchandiser is a business that sells merchandise or goods to customers. The merchandise that a business sells to customers is called merchandise inventory. A wholesaler is a type of merchandiser that buys goods from the manufacturers and then sells them to retailers. A retailer is a type of merchandiser that buys merchandise either from a manufacturer or a wholesaler and then sells those goods to consumers. The operating cycle has 3 main steps. A company purchases inventory from a vendor. The company sells the inventory to a customer. And the company collects cash from customers. What is a vendor? A vendor is an individual or a business from whom a company purchases goods. Here in Exhibit 5.1, it shows the operating cycle of a merchandiser. Okay, step 1, purchase inventory with cash, right? Sells the inventory, accounts receivable is created. Step 3, collects cash from the customers. So it's a cycle, okay? Because the operating cycle of a merchandiser is different from that of a service company, the financial statements are different. On the income statement, a merchandising company reports revenues using an account called sales revenue rather than account service revenue. A merchandiser also reports the cost of merchandise inventory that has been sold to customers, or what we call COGS, cost of goods sold. Now, because cost of goods sold, or COGS, is usually a merchandiser's main expense, an intermediary calculation, gross profit, is determined before net income is calculated. Now, gross profit is the excess of net sales over cost of goods sold. Operating expenses are expenses other than cost of goods sold that are incurred in the entity's major ongoing operations. Here in Exhibit 5-2, it shows how a service company's financial statement, that's on the left, how it differs from a merchandiser financial statement on the right. So as you can see, the financial statements of merchandising companies also look somewhat different from what we have seen so far. The most notable difference is that the income statement for a merchandising company here include the line items for cost of goods sold and gross profit. Cost of goods sold and gross profit. So here with the service company, you have service revenue. And service revenue minus operating expenses will give you your net income. Whereas with the merchandising company, you have net sales revenue minus cost of goods sold, which will give you your gross profit. So a merchandising company reports revenue using net sales revenue instead of service revenue. And the net income is the gross profit minus, minus the operating expenses. So the net income for the merchandising company is the gross profit minus the total operating expenses. It will give you your net income. The balance sheet shows a net asset account called merchandise inventory. Merchandise inventory is a current asset since it is expected to be sold within the operating cycle. Here you see the merchandise inventory. It is included in a merchandising company's current assets. A periodic inventory system is an inventory system that requires businesses to obtain a physical count of inventory to determine quantities on hand. The periodic inventory system is most appropriate for inexpensive inventory that is sold by small shops, small stores that do not have that optical scan or point of sale capability. A perpetual inventory system is an inventory system that keeps a running computerized record of merchandise inventory. In a perpetual inventory system, the cash register at the store is a computer terminal that records sales and updates inventory records. Barcodes are scanned by a laser. The barcoding is linked to merchandise inventory and cost data that are used to keep track of each unique inventory item. However, note that even in a perpetual inventory system, the business must count inventory at least once a year. The physical count captures inventory transactions that are not recorded by the electronic system, such as misplaced, stolen, or damaged inventory. The count establishes the correct amount of ending inventory for the financial statements and also serves as a check on the perpetual records. So this is the end of Learning Objective 5.1. We're going into Learning Objective 5.2. which is account for the purchase of merchandise inventory using a perpetual inventory system. So how are purchases of merchandise inventory recorded in a perpetual inventory system? How are purchases of merchandise inventory recorded in a perpetual inventory system? Well, the cycle of a merchandiser begins with the purchase of merchandise inventory. An invoice is the seller's request for payment from the purchaser. Invoices are also called bills. Sellers have sales invoices. Purchasers have purchase invoices. Now look at the invoice here from Southwest Electronics Direct. It shows that Smart Touch Learning acquired $35,000 of inventory, right? $35,000 of inventory on June 1st, 2025. Now, ignoring the purchase terms, the merchandise inventory account is an asset and it is increased with a debit. Here you see that the seller is Southwest Electronics Direct. The purchaser is Smart Touch Learning. You have the invoice date, the credit terms, the total of the invoice, okay? Smart Touch Learning payment date, June 15, 2025. And here, payment occurred 14 days after the invoice date within the discount period. So Smart Touch Learning paid, instead of paying $35,000, they got a discount. And we'll discuss that more, the discounts and the terms, the credit terms, in later slides. Okay, so on June 3rd, Smart Touch Learning will record the purchase by debiting merchandise inventory. Merchandise inventory is debit, cash is credit, okay? The merchandise inventory account is an asset and is used only for goods purchased that the business owns and intends to resell to customers. Office supplies, equipment, and other assets are recorded in their own accounts. Now, assume that on June 3rd, instead of paying cash, Smart Touch Learning received the merchandise inventory on account. Okay? So if the transaction is on account, then Smart Touch Learning will record a credit to accounts payable for $35,000. So at this point, we have not accounted for the purchase discount terms. Now, if Smart Touch Learning takes advantage of the discount, then we will adjust the accounts payable account appropriately at that time. So notice that we've added the name of the vendor after the accounts payable account. So this helps Smart Touch Learning keep track of the various companies it owes money to. Purchase returns are a situation in which sellers allow purchasers to return merchandise that is defective, or damaged, or otherwise unsuitable. A purchase allowance is an amount granted to the purchaser as an incentive to keep goods that are not as ordered. On June 6th, Smart Touch Learning returned $7,000 of the inventory to the vendor. This has the effect of reducing the assets, merchandise inventory, and the outstanding account payable from $35,000 to $28,000. That exact same entry is made for a purchase allowance granted to the buyer from the seller or the vendor. The only difference between a purchase return and a purchase allowance is that in the case of the allowance, Smart Touch Learning keeps the inventory. The purchase discount is from the purchaser's perspective. A purchase discount is a discount that businesses offer to purchasers as an incentive for early payment. Now, the payment terms of the purchase or sale are stated on the invoice. Credit terms of 3/15 and 30 means a 3% discount if paid within 15 days. Otherwise, the full amount is due in 30 days. Now, these credit terms can also be expressed as 3/15 and /30. Okay? The terms of N30 means that no discount is offered and the payment is due in 30 days after the invoice date. Now, most credit terms express the discount time period, and the final due date. Occasionally, the credit terms are expressed as EOM. EOM, which means payment is due at the end of the current month. Now, recall that we earlier recognized the vendor offered Smart Touch Learning sales terms of 3/15 net 30 days. Remember, you saw that in the previous slide. So according to the sales term, 3/15 net 30 days, right? Smart Touch Learning will receive a 3% discount if it pays within 15 days of the invoice date, which is June 1st, 2025. So if Smart Touch Learning pays on June 15, which is within the discount period, the company will receive a discount on the balance owed of $28,000 and not the original invoice price, which was $35,000. Okay? So if they paid it, they would get the discount and they would pay $28,000. So the discount amount will be $840. And how do we get the $840? It is the $28,000 times 3%. So when calculating a purchase discount, make sure to always calculate the discount based on the amount owed. Okay? This would be the amount of the purchase invoice less any purchase returns or allowances. Now, Smart Touch Learning records a debit to accounts payable for the amount of the invoice less any purchase returns or allowances, a credit to cash of $27,160, that is the $840 minus the $28,000, and a credit to merchandise inventory of $840. So the purchase discount is credited to the merchandise inventory account because the discount for early payment decreases the actual amount paid for merchandise inventory. So when making payment within a discount period, always debit accounts payable for the amount of the invoice less any purchase returns or allowances. Otherwise, there will be a balance remaining in the payable account even though the invoice has been paid in full. So after posting the entry to the accounts, the merchandise inventory account reflects a balance of exactly what the company paid for its merchandise, $27,160. And the accounts payable balance shows the invoice has been paid in full with no remaining balance. Okay. So notice that the merchandise inventory account reflects a balance of exactly what the company paid for its merchandise. This is what they paid. Okay? The $27,160. And the accounts payable balance shows the invoice has been paid in full with no remaining balance. Recall that we earlier recognized the vendor offered Smart Touch Learning sales term of 3/15 at 30 days. Now, Smart Touch Learning must pay the full $28,000, the amount of the invoice less the purchase return if payment is made on June 24th. Notice there is no reduction of the merchandise inventory account because the company did not receive the purchase discount. Now, this is taking into account that the company pays on June 24th, after the discount period ends. So next we'll talk about transportation cost. Purchase agreements specify shipping terms to determine when title of the goods transfers to the purchaser and who pays the freight. FOB shipping point. FOB shipping point. It is a situation in which the buyer takes ownership or a title of the goods after the goods leave the seller's place of business, which we call the shipping point, and the buyer typically pays the freight. The FOB destination is a situation in which the buyer takes ownership or the title of the goods at the delivery destination point, and the seller typically pays the freight. Here in Exhibit 5.4, it shows how the FOB term is determined as to who pays the freight. Now, either the buyer or the seller must pay the transportation costs of shipping merchandise inventory. The purchase agreement specifies FOB or free on board terms to determine when title to the goods transfers to the purchaser and who pays the freight. Freight in is the transportation cost to ship goods into the purchaser's warehouse. So it is freight on purchased goods. Freight out is the transportation cost to ship goods out of the seller's warehouse and to the customer. It is freight on goods sold to a customer. So let's look into freight in again. Assume that Smart Touch Learning pays $60 freight charge on June 3rd. They paid freight charge for a purchase with FOB shipping point. Now, Smart Touch Learning should record a debit to merchandise inventory of $60 and a credit to cash for the same amount. Explanation: paid a freight bill. Discounts are computed only on the merchandise purchased from the seller. Discounts are computed only on the merchandise purchased from the seller. Discounts are not computed on the transportation cost because there's no discount on freight. Under FOB shipping point, the seller sometimes prepays the transportation cost as a convenience and lists this cost on the invoice. So let's assume, for example, Smart Touch Learning makes a $5,000 purchase of goods, coupled with a related freight charge of $400 on June 20th on account with terms of 3/5 net 30. The terms of the shipment are FOB shipping point. So in this case, the seller prepays the freight charge. There's a debit of $5,400 to merchandise inventory. That's a $5,000, the cost of the goods, plus the freight charge. And then accounts payable to Klein Electronics is credited. So the explanation is purchase inventory on account, including freight. If Smart Touch Learning pays within the discount period, the discount will be computed only on the $5,000 merchandise cost, not on the total invoice of $5,400. The $400 freight is not eligible for the discount. So the 3% discount would be $150, and that is the $5,000 times the 3%. So there's a debit to accounts payable of $5,400. Cash is credited for $5,250. That's the $5,400 minus the $150 discount. And merchandise inventory is a $5,000 times the 3%, which is $150. So there should be a credit paid within discount period, including freight. The net cost of merchandise inventory purchase includes the purchase cost of inventory, less purchase returns and allowances, less purchase discounts, plus freight in. Knowing the net cost of inventory allows a business to determine the actual cost of the merchandise purchased. The calculation of net cost of inventory purchase is determined as you see here. Purchase cost of inventory minus purchase returns and allowances minus purchase discounts plus freight in will equal net cost of inventory purchase. So again, the purchase cost of inventory is minus purchase returns and allowances minus purchase discounts plus freight in. That will equal your net cost inventory purchase. During the year, Smart Touch Learning buys $697,710 of inventory, returns $150,000 of the goods, and takes a $9,510 early payment discount. The company also pays $36,400 of freight in. So the net cost is equal to $574,600. And so this is the end of learning objective 5.2. In our next video, we will go into learning objective 5.3, account for the sale of merchandise inventory using a perpetual inventory system. Thank you for watching. And please, if you haven't already, please click the subscribe button below.